Hello and welcome to Multnomah Group's Capital Market Review for the third quarter of 2023. My name is David Williams and I serve as the Director of Investment Services here at Multnomah Group. I'm recording this on October the 26th, and earlier this morning, the third quarter US GDP was released. That's the first print of three for the quarter, and the initial estimate for third quarter GDP was 4.9%. Annualized growth rate. That's the fastest growth rate that we've seen since the fourth quarter of 2021, so nearly 2 years, and it was far better than analysts had forecast. We saw strong increases in consumer spending, roughly about 4%. That's up from about 0.8% or 0.8% in the second quarter of 2023. Exports rose about 6.2%. That's reversing a decline in the second quarter. And we also saw strong results in both residential investment as well as government spending. Non-residential investment, or sometimes referred to as business investment, declined during the quarter. All in all, a surprising result, and again, far better than forecast. As we transition to the right-hand side of this page, looking at the jobs picture, the unemployment rate sits at 3.8% as of the end of September. That comes off of a very surprising non-farm payroll report where we saw about 336,000 jobs added during the month of September, far better than expected. We do see month-over-month increases continue to decline. If you look further back into the early part of the recovery from the pandemic, month-over-month increases have slowed. But the labor force participation rate has picked up to about 60, just a little under 63% here in the US, and that's up for the year. Wage growth continues to be strong at around 4%. And one of the often quoted statistics, the JOLTS report, shows that openings, while decreasing, are still higher than long-term averages, and the quit rate has remained steady, but again, above long-term averages. So overall, the employment picture in the US continues to look rather positive. If we move to the bottom left-hand corner and look at the other side of the Fed's dual mandate, maintaining stable prices, you can see just from the picture that inflation rate has come down. It's still elevated relative to the Fed's long-term target of around 2%, but we are seeing that inflation year-over-year increases are fading, although be it rather sticky, still above that 2% level. The headline number was roughly 3.7%. That includes energy. If you back out food and energy, the core rate was running right at about 4.1%. The Fed funds rate shown on the far right-hand side, lower right-hand side, continues to be high relative to this past 20 or 10 years. The Fed did increase rates by about 25 basis points or 0.25% at their July meeting, but however held rates steady at September. So the current Fed funds target is between 5.25% and 5.5%. The market participants do expect rate cuts as we move into 2024, although there is a thought that rates will increase one more time before the end of the year at either the October meeting, November meeting next week, or again when the Fed gets together in December. As we switch over to the capital markets, we'll start with fixed income. In the upper half of this page, you see the current Treasury yield curve in blue, and then the Treasury yield curve from 3 months ago in green and a year ago in orange. What you'll notice is that the yield curve took a parallel shift up for the intermediate, the 5 to 30 year maturity spectrum. So yields moved north during the quarter, as well as remained inverted with higher yields for shorter term investments, which is an unusual phenomena in fixed income investing. You generally expect to see higher rates for longer term investments, shorter at the lower yields at the shorter end of the curve. For the quarter, long-term bonds underperformed short-term bonds, treasuries outperformed like duration corporate securities or investment credits, and then high yield did a little bit better than investment grade during the quarter. It remains a very difficult market environment for bond investors as investors are demanding higher yields for investment in fixed income securities as investors remain cautious about the future economic growth prospects here at home and abroad. As we flip over to the equity markets, so we'll start with the U.S. equity market. The S&P 500 year to date is up 13.1%. The S&P 500 did give back about 3.3% during the quarter. We did see that energy and communication services sectors were positive, and those were the only two positive performing sectors for the quarter. All other sectors lost value during the quarter, with utilities and REITs leading the laggards. Growth and value in the large cap space were roughly in line with one another. We did see that large cap did better than small cap in general, particularly on the growth side of the equation. So as investors move down market cap, generally speaking, the losses were greater. The forward price to earnings ratio as of the end of September sits at 17.8 times. That declined during the quarter with the compression in valuation. But that 17.8 times for forward earnings does sit above the long-term average of 16.8 times. So stocks do remain expensive if you're looking at a simple valuation compared to historical averages. Outside of the U.S., stocks were mixed relative to stock performance here at home. The MSCI All Country World ex-US, which is a proxy for both developed and emerging market securities, was down 3.7% for the quarter. That's below what we saw for the S&P 500. Developed markets underperformed emerging markets, and developed markets actually underperformed the US, while emerging markets did a little bit better than the US. The Chinese market continues to be a drag on emerging market securities year to date due to both debt burdens and growth concerns on a domestic economic policy basis. Stock valuation outside of the US, the All Country World ex-US forward price to earnings ratio sits at about 12.5 times forward earnings versus a long-term average of about 13.1. So stocks do look a little bit better valued or more fairly valued outside of the US. I'll wrap up on this slide with just a quick look at the unpredictability of asset class returns, or sometimes we call this a quilt chart or a periodic table of investments. And what you will notice is, there is some volatility in the asset class returns. Sometimes those that did worse last year do better this year. And that's certainly the case with our sell-off in 2022 on risk assets in a reversal, year to date so far, with stocks really leading the way. Although cash sitting right at about 4%, cash investors are benefiting from that steep rise in Fed funds rate and movement upward on the short-term interest rates. Since 9:30, since we're almost a month after 9:30, I'll make a couple of quick comments. Stocks and bonds have sold off, generally speaking, as the level of uncertainty has increased, and we all know that investors really loathe uncertainty. They're looking, investors generally speaking are looking for predictability so that they can make long-term asset allocation decisions. We've certainly seen geopolitical risk rise with the continued Russia Ukraine war, but also since the end of September 30th, the Israeli Palestine conflict um, has come into focus. Jobs report was, as I mentioned earlier, much better than expected, which is supportive of the Fed's longer for or higher for longer narrative on interest rates, which that higher for longer interest rate position has an impact on the ability of the consumer to continue to spend as they're potentially spending beyond their means. They're having to service that with higher levels of debt, higher levels of interest burden on those consumers, as well as the fact that student loan debt repayments have restarted here recently. Continuing with the uncertainty narrative, we do see that the dysfunction in Washington has raised concerns about the um, ability or commitment to funding the government and maintaining a steady government functions, which does raise, again, concerns there. Um, on the positive side, corporations continue to print earnings that are growing and generally better than consensus. So it is a mixed bag, which does present opportunity for investors as the different narratives will play out over the coming months. I want to thank you for listening to our market commentary. If you have any questions, please feel free to connect with your consultant here at Multnomah Group or reach out to myself. Again, thanks for listening and have a great day.